Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. My name's Campbell Wallace. I'll be filling in for Stuart today, and I'm going to do some listener questions today. The first question comes from John. That's what he'd like to be referred to as. I'm going to paraphrase things here, but let me start just by giving a high level on John's and his partner's situation. So John's 44 and his partner's 41. His income's 150,000, partner's is 120,000. They've got 450,000 in cash in a high interest savings account. They've got 230,000 in shares in super. He's got 370,000. His partner's got 50,000. Now he goes on to write that he's been following a rent vesting strategy for the time being. So they rent where they live. They live in Brisbane and they've been renting somewhere for 7 years or so. And then they've been investing in that share portfolio that they've been building up. And that also represents that cash balance that they've got there because they sold some and now they're sitting on cash from that. So yeah, he explains that they've been running a rent vesting strategy by renting where they live and investing in the share market. And here's the dilemma they've got. So he mentions that we've been thinking about upgrading to a larger home in the next few years. So they have aspirations to buy a home in Brisbane in the next few years. But he says, given recent price increases in Brisbane, I'm considering buying an investment grade property in Melbourne for, roughly 1.5 million, and then continuing to rent for another 2 to 3 years, parking the surplus funds in that offset account. And then the idea is that that offset account can go towards the home later and potentially selling the Melbourne property in 8 to 10 years to reduce the debt. So in effect, what John's proposing or considering is, going and buying an investment property in Melbourne because he buys into the thesis around Melbourne being a good buying opportunity and, not so much in Brisbane given the increases in property prices there. But really his goal is they want to buy a home in the next few years in Brisbane. And John, I don't think that you should go and buy the place in Melbourne. I subscribe, absolutely, we do, to the thesis about the Melbourne property market. But the trouble you're going to have is you're going to use up all your borrowing capacity and you could find yourself stuck in a position where you then can't go and buy that home in Brisbane. I mean, I think really with this kind of time frame, if you're, wanting to buy a place in Brisbane, a home within the next 3 years, well, I think going and buying an investment property in Melbourne for 1.5 mil, that's going to consume all your borrowing capacity, and then really banking on the fact that it's going to do very well in the next 8 to 10 years, and then you can sell it to then pay off the mortgage on the home. I mean, there's a couple of problems there. There's a sequencing risk here. So we think that Melbourne's going to do well, but pinning yourself into that position where it really needs to do well in 8 to 10 years in order for you to benefit from the situation is a little bit risky. Property's long-term investing. Of course, when you've got a decision to make where to invest, you can choose that based off where you think there's going to be potential growth in the near future. But, it doesn't really work like that. Sometimes, with Melbourne, it could be years. It could be years before it enters into a growth cycle. We don't really know. We think that there's good tailwinds behind it. But, I think if you go and buy the property and you have that sort of time frame of 8 to 10 years to sell it, I don't think that's a good decision to make because you've also got the issue here of borrowing capacity. So if you go and, borrow 1.5 mil or call it 1.3 or 1.5 to buy that place in Melbourne, then you go, okay, great, we've got a good place in Melbourne. And then in a couple of years' time or a few years' time, you go, now we want to buy that place in Brisbane. I'd think off your incomes, I think you're going to be stretching it. You probably won't be able to then go and get a mortgage to buy that home. So I really think the home's got to come first. I mean, I've done a previous article, John. If you go and listen to episode 351 called Rent Vesting versus Home Ownership, I really do some numbers on the rent vesting strategy. And absolutely, there's a number of scenarios where I think rent vesting is the preferred strategy. And I sort of outlined them in that episode. But I don't think that those strategies apply or those situations apply to your situation. I think that really, where you want to live and you have aspirations to buy a home in Brisbane, I think you should do that. I don't think you should wait. I think if you go and buy an investment property in Melbourne, you're then going to be stuck on borrowing capacity in a few years when then you want to buy in Brisbane, and then trying to bank on a short time period of then needing to sell Melbourne to, create some capital out of that can go towards the home. I don't think that's the way to go. And I also think Brisbane has got legs still. I think Brisbane's going to continue to perform well all the way, through the lead up to the Olympics. I don't think that the cycle's ended in Brisbane. So, if you're kind of considering, well, Brisbane's at sort of all-time highs or it's at its peak at the moment, I don't quite think that that's right. I think you'd still be, if you went to buy a property in 3 years, I think that there's a fair chance that you're going to be buying that property for a fair bit more or more at least than what it's worth today. So I think naturally you got to lock in that property as soon as you can. There's a middle ground here. I mean, you don't have to move into that property straight away. This is the thing with the rent vesting where I'm quite comfortable with and I'd be quite happy with for clients is a bit of a middle ground where you continue rent vesting, but you buy that future home, lock it in today's value, and you buy it and rent it out. So if you wanted to continue with your rent vesting strategy, it's certainly better cash flow wise in the short term rent vesting. So you'd continue renting where you are, and it's quite a modest rent. You've listed it here that you're paying to live where you are. So yeah, for sure, you could go buy that property, the future home, and you don't have to move into it straight away. So, get some negative gearing benefits, get some help from the tax office in terms of the holding cost. You could do that, but then it's always there. It's ready for you to move into when you're ready. And even still as well, if you bought somewhere that was, it's just the land that you're wanting to secure. So it might be a really older home, run down. It might need a renovation. It's going to need some work to it for you to be comfortably living in it down the track. I'm quite comfortable with that strategy as well for people. Really what you want to lock in is the location and the land, and lock it in at today's value. And if, then it requires renovations to be done down the track, that's okay. So look, I think you could do that. That's still a rent vesting strategy technically, but I think you'd really want to be securing that land, that property, as soon as you can. Because one of the elements that I don't like about the rent vesting strategy, and this might not be exactly what you're talking about, but some other people talk about this idea of go and buy multiple investment properties and then you sell them at a certain point once you've got enough equity to then buy a future home predominantly with cash, or almost all entirely with cash, because then you don't have non-deductible debt. I've heard that spoken about a little bit by a few different people. I get that. That makes sense. The problem still is that you're buying in future value. The idea is people say, oh, you go and buy this property, buy 3 investment properties, and they go up in value by X amount per year in growth. And then I use that equity to then sell to then go and buy the home in 20, 30 years' time. Yeah, well, the home's gone up in value the same amount. And so to equal amounts, you would think, if you're buying in decent areas like, you are in Brisbane or other people are in capital cities. So you're still in the same situation. If those properties, then you're buying in at something that's gone up by the same amount, what it's worth in 20, 30 years, if that makes sense. So there's an issue there with that sort of strategy. But I think in my mind, John, wherever possible, you've got to try and minimize or reduce transacting in property. You don't need to. You can still do this rent vesting strategy and you can avoid a transaction. And that transaction is having to sell a property. So it's expensive. Like in every transaction, there's capital gains, there's selling fees, there's agent fees, there's stamp duty in buying. It's properties, it's an expensive asset class to transact in. So I'm really not a big fan in lots of transacting and people sort of, hotspotting and buying and selling, that type of approach to things. I'm not saying that you are doing that, but this is speaking more broadly about this topic. I think for you, you've got the ability here. If you buy your future home and then if you continue to rent it out, that's no problem. If you rent it out for the next 3-5 years, that's okay. And then you eventually move into it, that's fine. But you've prevented a transaction. You're not having to transact. You're simply just moving into your investment property, and there's no problems from that perspective. But having to throw in, buying that place in Melbourne, paying your stamp duties costs on the way through, holding it, quite risky for a relatively short time for property investing, and then needing to sell it to then, go and buy that future home, which I think you would need to, because I don't think that you would have the borrowing capacity to buy the future home on top of the Melbourne property. So you're throwing in an extra transaction there, and I think that's not going to be the most effective manner, and I think it's also a little bit risky. So yeah, John, I think looking at your situation, I'd encourage you to buy the future home in Brisbane, and yeah, you don't have to move into it straight away, but at least secure it at today's prices. The next question now is from Steve. So Steve writes to me and it explains how he has invested in a property development, which is via a trust, which is being managed by a wealth business. So Steve invested about $200,000, which he believes equates to about a 25% stake in this trust setup. Then he goes on to explain, in order to fund that, he took an investment loan from the equity in his home of about $165,000 and then made up the difference there with cash. And so he's been paying this loan. So he's had this loan and he's had this investment in place for around 2 years and 4 months. And there was a delay with the development approval for that property inside the trust. So there was some delays in getting it, so that the property was only bought quite recently, as I'm understanding from reading this. And as Steve explains, the idea of the property development was to buy this property, develop it, build it, and sell it. So really quick sort of turnaround flipping of this property. He says that, it's done quite well. He's expected to receive his money back, the roughly $200,000 plus a profit of about $200,000 to $250,000. So that's pretty good. And that's been 2.5 years, roughly, might be 3 years by the time that happens. But he mentions that the property won't be held for 12 months, given it's how long it took to acquire the property. then the build, and then they're going to sell it. So they're potentially going to have a sale within 12 months. And the issue there obviously being about whether, the CGT discount of 50% applies because of the asset hasn't been held for over 12 months. So really, this is what Steve's question is around here about the tax implications. He's trying to understand, he's been told that there will be no tax implications on his investment money of the 200,000, but he's not sure about this and he wants to check it and understand it. So Steve, let me start by saying I think that there will certainly be tax implications. I'm sorry to tell you, I don't know how you've been told. If you get your 200,000 back plus a profit of 250,000 from this trust, there's going to be tax implications for sure. Upon the sale of that property, that's a capital gain, so there will have to be. And so let me just explain here. I'm reading between the lines. I'm going to guess this trust setup is a unit trust, which is, different to a discretionary family trust. I think that this type of property development that you're in, given that it's run by this wealth business, as you've mentioned, I'm guessing that this is a unit trust, so you bought units in this trust. So even still, it gets taxed at the beneficiary level. So the unit trust doesn't pay any tax. It could, but if you held the income and the capital gains within the trust, it'd be taxed at the highest marginal rate. So that's typically not what most people do. With these unit trusts, any capital gains or income flows through to the beneficiaries. So, and with unit trusts, it's applied exactly as per the unit holdings. So you own 25% of the units in this trust. So 25% of the capital gains and income has to flow to you. And that's kind of the difference between, just FYI, between a discretionary family trust is there's full flexibility in distribution to beneficiaries with a discretionary trust. But with a unit trust, it's set in stone. You own X amount of units, X percentage, and therefore that has to go to you as the owner of them. So yeah, I'm afraid, Steve, with the sale of that property, I would have to be a capital event, and then that will come to you. And look, if that acquisition was less than 12 months of that property and then selling it, then you wouldn't satisfy the CGT discount because you haven't held the asset for over 12 months. So I'm afraid there would be capital gains, and that would then be applied at your marginal tax rate, and that would flow to you as a capital gain and applied at your marginal tax rate, and you can calculate the tax accordingly at your marginal tax rate. I'm guessing perhaps, I'm reading between the lines here, but the fact what you were told that there was no tax implications on your investment, on your money, on the 200,000 that you invested, maybe what that person means is that, there wouldn't be anything tax on that initial 200,000, but there is tax on the capital gain, the profit that you've made. And maybe also what that person's told you is that there's no tax within the unit trust, but there is tax for you personally as the unit holder. So when that capital gain, profit, income, whatever it is comes to you personally, the tax is going to be paid by you personally based off that profit or capital gain made. So then Steve then goes through a few options then around, how to mitigate that tax implication, whatever it ends up being. So, the first one he mentions is reinvesting the profits back into a similar investment to build to sell, hence delaying any tax implications. So I don't think that would quite work. The tax will need to be paid for that financial year when you end up doing your returns for that financial year. So there's naturally a bit of a delay there in terms of when the tax is actually paid. It doesn't get paid immediately. If you realize these gains in this year, it's not until you end up doing the tax returns for this year that you pay that tax. But there's sort of no delaying it and reinvesting the profits back into another investment. That doesn't mitigate the capital gains or the tax implications in any way. You're just reinvesting the funds, but the tax bill will be coming eventually. So I'm not quite sure if that works, but maybe what you're saying is, what if you invested in another investment, which then generated profits from that, and then the profits from that could then pay the tax bill from the first investment? Yeah, I guess so, but there's going to be tax from that next investment as well, and you're kind of compounding risk here and hoping that the next one does well as well, which it might. But look, there's no real way of avoiding that tax payable. There's a few other things here, and you go on to mention, you could look at using concessional catch-up contributions in my wife's super fund. That wouldn't work if, I think you mentioned earlier that the investment was in your name. Oh, actually, sorry, you've mentioned here that the investment's in both names. So doing catch-up contributions would mitigate the tax component in your wife's name, but it wouldn't mitigate any of the tax in your name, obviously, because the concessional catch-up contributions are for your wife, but you might be able to do them for yourself as well. Yep, certainly. That's a great way, using those carry forward concessional contributions to mitigate the capital gains. That's certainly something that would help. Steve also mentions, using the return on the investment to clear the investment loan. Yeah, absolutely. Certainly you can do that. That's not going to help the tax implications, but that's going to, just help you pay off the debt. So you clear the debt and then you take the equity or the profits that you've made from that investment. Yeah, sure. Absolutely. You can pay off that mortgage, but it sort of doesn't impact the tax implications. They're still there. there. So I guess coming back to that question about what could you do with the proceeds once you get this profit here, Steve, what could you do with it? You mentioned reinvesting it back with this same, wealth manager and into another unit trust for a similar investment for a development. Look, I don't know, but I'm always a bit of a cynic here, and I just question the level of risk involved here, because in a 3-year period, you've doubled your money. So you said you've put in 200,000 and you're expecting a 200 to 250,000 profit in return, and as well as your initial capital back, and then plus. So you're doubling your money in a 3-year time period off a very quick, that's an extreme, very high return on investment. And I could only think that this is a very speculative type investment. So I don't know the details of it, but I just question, should you just be doubling down constantly on this and doing it? I don't know. It seems pretty risky to me, but I'll leave that decision with you because you'd know more about the specifics of it. But sometimes things seem too good to be true. I mean, if there was something where you could easily just double your money, park it, double your money in 3 years, go again, double your money in 3 years, and it wasn't super high risk and speculative, let me know. But, I just sort of question that, and I'd just be a little bit wary there, Steve. Right, the next question now is from Namak. That's what Namak would like to be referred to as. So Namak provides some very nice feedback about the podcast. Good on you. Namak unfortunately made an investment in a stock which was listed on the ASX some years ago. Then it was delisted from the ASX. So then held onto it for a while, but recently he invested only about $1,000 from what I'm understanding here as his initial investment. And it was a very small cap speculative type stock, and it's been delisted from the ASX. And he then used a company which I hadn't heard of. It's called delisted.com.au, it's basically, I had a quick look, it's a website which it'll buy back delisted stocks. So when stocks get delisted from the ASX, you're unable to trade on them then, or it's very difficult to trade on them. And so this website, it looks like, effectively it buys them back off you and allows you to crystallize a capital loss. So when you're in a position where a stock has just gone down to a value of nothing, but it hasn't sold yet, you don't get the benefit of the capital loss. And, capital losses can be beneficial then for future benefit because they get carried forward into the future. So then if Namak then has a capital gain from, property or shares or anything else in the future, he can use this capital loss to offset some of that capital gain in the future. So this company's whole premise, this delisted.com, is they will buy back your delisted and untradeable stocks in order to create that capital loss for you, which you can then apply on your tax return. So Namak explains that he's done that through this company. So Namak, I haven't had an experience with this website, just for disclosure, but he explains that he's done this. However, he received confirmation of the execution, but then he didn't receive anything else from them. So he didn't receive any money back, and he says that they've just crystallized it. And he's asking the question now, what do I do in terms of my tax return? What do I put in as the capital loss, and how do I do that? So Namak, you should, even though this is a delisted stock and the way that this company works, in any trade, buy or sell of a stock, there should be a contract note. So in any other brokerage account, so like think about a CommSec account or any other sort of share trading account, there will always be a contract note for a buy or any sell. So you should have that confirmation. I'm hoping that you have that, a contract note. And that contract note should say, here are, X amount of units in this stock, and here is the price of which we bought it back, and let's assume that price is 0, and therefore it should say, here is the sale of these stocks sold to this company, and here is the units and here's the unit price, therefore there is the consideration. And that's what you then apply to your tax return. So I'm hoping you have that, a contract note. If not, follow up that company and get that, because you need that confirmation, that contract note, for accounting purposes. Namak mentioned he also had to pay a fee of $150, which is a bit of a in order to create this capital loss. In order for them to buy back this stock and to execute that trade for him, he had to pay effectively a brokerage fee of $150 in order to create that capital loss. So his question is, when I'm applying the capital loss from a tax perspective, do I include that brokerage as well? Yes, you can. Yeah, that goes down as an expense that would go towards it. So yes, you could include that, but that should be a consideration in that contract note. Again, Namak, it should be listed in there. You should have that confirmation in that contract note, which says, here's the sale and here's the brokerage for that sale. And that would be included then in that capital loss, which you then get applied going forward. I'm sorry that investment didn't work, Namak, out. That didn't work out for you, but I hope that helps. The next question now is from Tien. So Tien, he's only 21 and he writes that he just purchased his first home. Well done, Tien. So it's around 500 metres from his parents' house and he's provided me a link to it here. So it's in Brunswick West and as he outlines, it's a bit of an older house. It needs some improvements. So he's going to move into it, do some painting, flooring, then he's going to move into it for a while and then he says potentially rent it out and move back home or stay in it if I enjoy being out of home. And he's aiming to make use of the 6-year exemption rule. So let me just touch on this point first, Tien. Boy, we get a lot of questions about this 6-year exemption rule. I answered a question in a previous podcast a couple of weeks ago about this. You need to be really careful here, people do, with the 6-year exemption rule. You can't move into a place and then move out of it purely for the intention of getting that tax exemption. You get caught up in tax avoidance law. Really, you need to, I think for you, the advice I'd give to you is move into the house fully intending to stay in the house longer term. So you need to have all intentions to be living in that home and nominating it as your main residence. And you need to move in, you need to start paying rates, have bills, have your address updated to it. Need to be in there, I'd say do 6, well, there's no exact time period, but, to be really safe, do, 12 months in there, maybe 6 months at a minimum, but there's no specific time period here. But the key is that, you need to have that address completely nominated as your residence. You need to be using electricity, water, all the works, and you need to have your address updated to that address on various different registrations. So I think that's the first thing I'll say. You need to do that. Then if you're in that property for quite a while and you find you don't enjoy living there and I don't know, maybe the mortgage is too much or you're just not liking it and you'd like to move back with your parents or you want to go back to help your parents with something, there's some reason like that. And if that reason is justifiable and evident, then you can move back and then you should be okay to potentially access that 6-year exemption rule. So just need to be careful there, Tien, with that one in terms of the 6-year exemption rule. It then moves on. Tien sort of gave me a link to the property and he said, look, my thinking with this purchase was to get as much land as possible, as close to the CBD as I could without locking myself into an overwhelming mortgage and still enjoy my living and travelling in my 20s. His question is, look, the property's on a bit of a pseudo main road. Would you still consider this to be investment grade? So look, Tien, I'm not going to say the address of the property, obviously, but I had a quick look. Yeah, look, I'd agree with your description there. It is a bit of a pseudo main road. It's not an absolute huge main road, a huge thoroughfare, but yeah, I think that road there does cover a lot of traffic. So it is, that is an element to the property. Would I consider it investment grade? Look, it's hard to say. Is it A grade, like absolute A grade? No, it's not. And you probably know that. But look, you've done some right things here. It is pretty close to the CBD. It's in that sort of decent range. Brunswick West is, that's a decent sort of suburb. You've got a high land value component here. So you've bought something that's predominantly land value. As you've mentioned, it was one of the lowest dollar per square meters that you could see close to the CBD. So that's great. I like that analysis and that's good thinking there. And look, and I think that that'll do well. You asked the question, do I think that the inner northwest of Melbourne is currently undervalued? Well, yeah, I probably do. But I think that a lot of parts of Melbourne are undervalued. I think broadly speaking, this isn't specific to the Brunswick West and the inner northwest area of Melbourne. We think Melbourne, broadly speaking, is undervalued. So I think that would be captured within it. So I'm not going to get too specific into whether Brunswick West and that area is undervalued, but I think you're buying it at a really good price point in terms of the overall market cycle. Tien then asked the question about, capital gains tax. He said, if I had some housemates living with me during that year, when this first year when he moves into the property, would that affect his ability to claim, the main residence exemption and then the 6-year exemption later on? No, it wouldn't, Tien, but it would be proportioned. So to your next question here, would I need to apportion the CGT exemption because part of the property would be income generating? Yes, spot on. That's how it works. So you're effectively renting out by having housemates in there paying you to live in your house. You are generating an income from part of the property. So it would be apportioned as you've outlined there. So you would have the main residence exemption if you do all those other things and you meet the main residence exemption. Assuming you do that, you would still have it, but then apportioned by, if it's the one room or however that's determined, it would be apportioned that is CGT accessible, the part for that renting it out for having those housemates in there. So yes, as you've alluded to, that would not be exempt and that would be accessible in terms of capital gains when you eventually come to selling the property down the track. But look, conversely as well, I mean, if it's then deemed that portion of the property is income producing, well, then a portion of the expenses for the property can be deductible on a cash flow basis. So, the interest on the loan. So then whatever that portion is, say it's determined that 20% of that property property is income producing for the housemate that's in, say it's in one property or the like, one room of the property, then you could apply that same portion to make your interest and other expenses for the property deductible. So it helps you in terms in the short term as well. Tien then goes on to mention, look, a lot of your content is geared towards high-income, middle-aged investors, but is there anything special you'd recommend for someone like me, given my asset base and given my age? So look, Tien's given a bit of additional information here. So he's got obviously the property that we've just discussed. He's got 70,000 in savings, and he's got 170,000 in shares in index funds. So look, I'd say, Tien, look, you're doing really well. Look, for a 21-year-old, I certainly didn't own a property like you have at 21. You're ahead of most people at 21 years of age. So leaps and bounds, particularly with the share portfolio as well. So hats off to you. I'd say, remember to enjoy yourself. Don't absolutely break your back. I wouldn't say, go and buy like another property and really gear up and, that's going to use all of your surplus cash flow to do that. You got to enjoy life at the same time. And you've mentioned here travel and that sort of thing. So you've got to do that. And I think by securing this large asset now, you're far ahead of most people at 21. And a lot of the work will be done for you just in terms of capital appreciation with this property over time. So I think just continue doing what you're doing. You haven't mentioned super at all, but I mean, geez, you're so young that it's not even really probably in your scope, super, but I don't know what your employment arrangement is. So maybe you've got employer contributions going towards super. So it's probably not too much of a concern, but I'd just sort of settle in on where you are at the moment, build up a bit of a cash buffer, because after this transaction, you don't have too much cash now to sit in the offset account. Build that up, continue your regular investing in your share portfolio as you're doing, and I think let capital growth do the work. And then over the next sort of maybe 5-10 years it might take to then position yourself you might be in the position to then buy an investment property, another one. I know that this one's sort of being treated as an investment property some ways, but maybe then you add another property in 5 to 10 years, you'd only be 30 then, so you're still very early on. But if it works for you at that point, add another property then, and you can continue going from there. Use the equity from the current property and leverage into another one. But look, not too much else, but just making sure, sort of following, if you listen to a lot of the podcasts about, how you're investing in shares, how you're going about that, and then the super that you've got, how you're doing that, the loan structuring, how you're doing that, I think you're doing it all quite well. So look, I'd say keep up the good work, and I don't have anything too specific for you. Yeah, I hope that helps, Tien. Okay, that's all I've got time for today. Until next time, bye for now.
Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.